Hi, guys. Welcome to the ninth episode of WTW, the weekly trading wrap up, where we talk about the week in markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. Okay, as usual, excuse me, I'm recovering from a bit of a cold, but that's neither here nor there. Okay, as usual, we'll start off with the S&P 500 daily chart. This is the week of the 13th. Monday, Tuesday, Wednesday, Thursday, and Friday. Two gaps up. Now, it was a very light week in terms of macro, but important macro came out. The inflation numbers, the PPI and the CPI came out on Tuesday. But as of Monday, we were continuing the fear that was happening on Friday. Okay, a Friday close like this is very bad. So on Monday it opened up even lower. Okay, and we had conditions here in the fear and greed index of like extreme fear at one point. Everything was at extreme fear. All of these factors were at extreme fear. Okay, because of the current market narrative. The current market narrative. Let's reiterate. Yields are going through the roof. Okay, strong economic data and news will lead to higher inflation expectations, which will lead to less future rate cuts because everybody was pricing in rate cuts, 5, 6 rate cuts in 2025, and now it's down to one. So future rate cuts are bad for stock and bond markets, which lead to lower stock and bond prices, so you sell. Okay, everybody was having that fear in their heads. Okay, forget about. We talked about last week how this is completely wrong. Any one of these five that are wrong premises will destroy the whole narrative, and I'm not a believer of this narrative, and I explain why. But that's what is gripping the market recently, and we have to play within that. So let's go back to the S&P 500. So because it was a very light macro week, Monday opened up gap down. Okay, let's go into the 15-minute chart here so you can see it. Where are we here? Okay, here's Monday. Here, this is the Monday 15-minute chart. Gap down, they started buying it, rehit, retest, I should say, and then up to fin. This is the end. This is like 4 o'clock on Monday, and then gap up Tuesday. Okay, so on Monday, the fear continued from Friday that inflation is going to go through the roof, yields are going to continue to go higher, and we're in trouble. The Fed can't cut rates, and if we can't cut rates, then that must suck for the markets. So markets are going to suck. It goes down. Of course, that's not the case, and this is what you have here. Okay, you had exhaustion and then buying throughout the whole day to finish at highs. That's very, very positive. Okay, and this translates into that. This translates into this daily candle. Open down, gap down, open, and then closed everything and finished at highs. This is exhaustion behavior. And it was at extreme fear. Everybody was shorts were being added here. Okay, people were buying puts for protection and for speculation. So here this brought things into extreme fear territory, extreme fear positioning, short positioning. Everybody says we're going to crash now because of this. Let's go back to like TLT now. Not TLT, sorry. The US 10-year yield. That's Monday. So Monday, as you can see here, we're approaching the highs of 5% on the US 10-year. We were, okay? On Monday, it was like right at this little red thing is Monday. Okay, by this red arrow indicates Monday. So this was still gapped up. It was very high. Fear was palpable. You can smell it. Okay, it was still there. Look, you have the yields that are double bottom, breaking the neck, which could go even higher to 5.25% yields. That would crash the market, etc., etc. Despite the fact that they're still overbought here. But it doesn't really matter that. I'm just saying that you would have to really believe the narrative that the bond vigilantes are back, inflation's high, and the Fed is going to, not only not cut rates, but go into a rate hiking cycle to avoid inflation, which I think is ridiculous at this point. So this was the fear. Everything was positioned on the short side. And of course, when that happens, you get a snapback rally. Let's go back to SPY. As you can see, this is the effect of it. Okay. Tuesday, Wednesday, Thursday, Friday, up week. Okay. But on Monday, the fear was palpable because there was no real news coming out. So it was just a continuation of the prevailing narrative. Okay. So that's what was happening on Monday, because everybody was waiting for Tuesday, the PPI report. Okay. So what happened in the PPI report? It came in cooler than expected. That was Tuesday. Now we're finished with Monday, talking about Tuesday. PPI came in cooler at 0.2% month over month. This is the PPI. It came in at 0.2%. They were expecting 0.3%. Okay. So as you can see, the PPI here, let's go like a 3-year average. It's hovering around these levels. It's about 0.2, 0.3. It's pretty much flat. No real producer inflation. Stuck at these levels. Okay. But that was enough to get alleviate the pressure from the market. Everybody was positioned short. That allowed the market to go up, retest down. Though people were still, there's still some shorts out there. They weren't completely exhausted. They took it all. You could see this wick, this candle. They took it all the way down again, only to finish at the midpoint. Okay, because even though the producer price index came in slightly colder than expected at 0.2% instead of 0.3%, the narrative that's been building here is still very heavy. It's still in people's minds, okay? And not one print is going to change that, okay? And especially the PPI. We talked before that the PPI is not an important inflation measure. I mean, people look at it, but the Fed doesn't. The Fed looks at the core CPI and PCE, okay? And core PCE. And the market knew here that on Wednesday, the coming day, is when core CPI comes out, which is the more important inflation metric. So here they were still selling. They were still trying to position themselves for a hot CPI coming in on Wednesday. Okay, so even though the PPI came in cooler than expected, everyone was saying, "Oh, for sure, we were going to get the CPI is hot," because I mean, if you looked at so many narratives, if you look at Zero Hedge and all these sites, everywhere you look. All the news sites, they were saying that we're going to get a hot CPI number. The ISM manufacturing prices paid was up big, so therefore we're going to get inflationary pressures. We have oil. If you look at oil, oil was going up. Okay, this is Monday oil. This right here. So gapped up Monday and Tuesday. Oil was high, so oil's been going up. That's an inflation proxy. We have copper futures. They were going up. That's Friday, but this is Monday, okay? Monday. They were still going up. Okay, so this whole move in copper recently is inflationary, apparently. Okay, so you had all of these narratives built in on Tuesday, betting on a hot print for Wednesday, okay? So that's why it retested the lows. If you can see that wick, we can go back to the 15-minute chart again for Tuesday, which was here. Gap up open, raised up because of the PPI figure, and then all the way retested back down, like almost back down to the lows of Monday, okay? Rebound again, and then back down to the lows, because people were still positioning themselves short for a potentially hot CPI number the following day on Wednesday, okay? So Tuesday was still fear, a lot of fear in the market. Let's go back to the day. They were still not believing it. The narrative, the current market narrative, I would call it, let's say, the bond vigilante narrative or the Druckenmiller narrative, still very fresh. One print isn't going to do anything, okay? So let's go to Wednesday now. This gap up day on Wednesday and finish at the highs, it was just a very, very strong day. CPI comes in, core CPI comes in at 3.2%. Okay, they're expecting 3.3. Comes in one lower than expected. Okay, let's see what the CPI here, 1 year, 3 years. As you can see, CPI has been coming down. Core inflation rate is still 3.2%, stuck around the 3% level. Okay, but the print came in cooler than expected. Core. Let's go to what is it? Core inflation rate, month over month. Yeah, 0.2%. They were expecting 0.3, as they were for every other month. They were expecting 0.3. They got it slightly cooler. Following our original narrative, but putting a pin, trying to prick the balloon of the current narrative of higher yields, higher inflation. Okay, so that completely reversed. I'm sure a lot of short covering was happening here as well. Okay, so you had the big core CPI reversal that's probably going to destroy this narrative going forward. It's still strong though, but it has to get destroyed more. Okay, and that only happens when this will probably go around the greed and extreme greed level. Okay, so we have a lot of room to go. Okay? Doesn't mean there's not going to be ups and downs, but as I was saying, I think this was the bottom, and we're going to go up to probably new highs. I'm thinking around the 620, 630 level, as I mentioned before. I'm guessing, I don't know, I'm guesstimating 620, 630 before another correction happens. Okay, so we don't know that yet, but that's just my guess. Okay, so that was a big Wednesday. Okay, what happened on Thursday? Sort of a consolidation day, an inside day there. We did have some good macro data. We had the initial jobless claims, which we always look at, but this time they came in hotter, 217K. Okay, whereas they were expecting, 203 previously, and they were expecting about that much. What were they expecting? I can't really remember what they were expecting, but it's higher than the previous 4 weeks. Okay, so this we have to keep a look at. It's just 1 week. Let's see, it might drift lower afterwards, but let's see. We don't want it to continue going this higher. So still within our range. It's not crazy. It's still at 214. We're not getting. Oops. Let's go here. Sorry. Let's go to max and blow this up. Okay, we're not getting these kind of explosive moves higher. It's still going lower. Okay, we're not getting initial claims coming up higher, trending higher a lot. Okay, so nothing to worry about just yet. 214 is not a big deal. 217, sorry, it's not a big deal. Okay, even though it's a big jump from here, we should just be wary. It's still within our range. It fits our narrative, but it doesn't fit the bond vigilante narrative, the prevailing market narrative. Okay. So what else came out on Thursday that could have had an impact? Nothing really. The Philly Fed manufacturing and retail sales came out. Both were up, which confirms that the economy is doing better than people are expecting. Like I said, I think the economy is doing well. The economy is holding up. It's not crazy, but it's doing well. We're not in a recession yet. Okay. So that's, I mean, you can ignore that. They're not that important, these macro data points. We already discussed what kind of macro data you should be looking at. Okay. So Friday was just a continuation of this whole week. Okay, gap up. Friday's when all the guys come in. It's Opex, so it could have been some shifty stuff happening. Okay, but it wasn't that, for Opex, it wasn't that big of a volume day towards the end. Okay, but we did have some good macro data here. We had building permits. What happened with the building permits? Building permits came in at 1.483. million versus 1.493. Oh, what am I looking at here? Oh, Canada. I'm looking at Canada value permits. No. Looking at the United States. There we go. Came at 1.48. Okay. Versus 1.49 here. So building permits slightly lower than before. Nothing to worry about. They're not collapsing, and they're at good relative levels. Okay. We also had housing starts, and they're up, but we don't look at that because that's pretty much a lagging indicator, and you can ignore industrial production, everything else that came out here. So the big news on Friday was building permits, and it didn't really do much to move the needle. However, what it did do was confirm the fact that we were correct in being bullish when everybody else was selling here and buying when everybody was scared. Okay? So what we could be talking about here is that what is the narrative going on here? Like, why did this happen? Like, how did this whole shift happen? Okay, because for all of 2024, we had a narrative of like, let's write it down. Okay, let's be a little bit more professional. Let's write it down. Okay, we had at the time we had the current the current operating narrative. The current operating narrative of the time was as follows. Before we had GDP growth, or we should say moderate growth of 2 to 3%. Nothing crazy, going up slowly, what you want to see, not very inflationary, okay? Okay, we had jobs holding up, not tanking. We had inflation falling, so Fed can start lowering rates meaningfully. Okay, so we were getting maybe 2 to 4 rate cuts priced in for 2025. Okay, this is like the perfect scenario. Okay, let's call it the Goldilocks scenario. Rate cuts, okay, with the market going up. It's incredible. You had, let's go back to the market here. 2024 starts here. The market going up with rate cuts, no recession. It's like adding fuel to the fire, okay? Goldilocks economy, that's why everything was going up. So what changed? It changed around here. November, December kind of area. When really we should be looking at the US 10-year to tell you exactly when it changed, around here in September. Okay? Around September is when you started seeing these yields come back up. Okay? And SPY around September was here. Oh, sorry, here. Okay? So the market was going up, however, the narrative was beginning to change. Okay? So nobody really cared when the US 10-year yield being in a downturn was just going up a bit here, okay? Because it's still within a downturn in the range. Here, nobody, maybe we should get a little bit weird. Oh no, we're going back down. And boom, this is where the real worry started in December, okay? And you can see that from SPY. So as we were going up, as the market was going up, yields were also going up, but people started worrying around these levels, around December, okay? When you saw, around December, okay? Because here was November 15th, and it started going down. People were happy because it's still within the downtrend, okay? But then here, December started going back up again, fast, hard, and breaking these levels, breaking this one. So then people started getting worried, and this is when the market really started shifting. Fast acceleration when inflation numbers were being, up and up. This is where they started really changing the narrative, okay? So back to SPY, as we can see, like in December, the beginning of December, then it started tanking, okay? But you see, like it just fell 5%, nothing big. This is normal. This is actually better than normal in an upward, in a bull market. A 5% drawdown getting to extreme levels is nothing. It shows underlying strength in the market, okay? And that's what we were observing before. That's why you don't panic. You have to buy when it gets to extreme down territory at these levels when the fear and greed gets really extreme, okay? That's when you should be coming back in, okay? Which we did. Okay? Now, we have the current operating narrative, and it switched into one of fear and higher rates. So it's going to take some time before that. It might not take a lot, because if you saw that the first narrative, where was it? Here. This narrative now, instead of having 2 to 4 rate cuts, we're down to 1. Okay, now, if we can get another 2, 3, with inflation going down slowly, and jobs holding up, boom, we're going to get back to this current operating narrative of 2024, I should say. Of beginning 2024. Okay, we can get back to this fairly quickly because it hasn't been that long that the bond vigilante narrative came into play. Okay, and if you can destroy this, we can get another move higher, and then something else will come up. Maybe inflation sparks again. Maybe we get to the US 10-year down to like here, 4.3, maybe 4.2, and then starts going up again. Maybe people will think it's, the bond vigilantes are back and inflation is back before it starts going down again. Okay, we don't know, but from now on, like if this narrative could quickly, if we go to new highs, the narrative is probably going to change. Okay, which I suspect it does. I don't know if it does it in a straight line. It probably won't. But so far, this is good action. Okay, let's see what happens next week. Trump is coming in. Maybe we're going to have some boost there of like optimism. Then remember the first term, how well he did. Rate cuts might happen as well. You don't know. Like, of course, it'll explode the deficit, but you're going to get a boost of euphoria because they're going to remember that in this first term, inflation wasn't a problem. So this is how the market moves. You have to like change narratives, come back to the original one. It's an ebb and flow, but you have to act when you're scared, not when things are doing well, okay? Because there's no risk reward there. Here, there's good risk reward. Here, there's good risk reward. Here was beautiful risk reward. This was the perfect entry, okay? So that's it for a crazy week. Looking forward to next week and Trump's term becoming official. And of course, nothing has changed, so we are going to stay bullish.